Please confirm that you have that question with you. August of 2024, and that is the question 4B. Question 4B. Are you there? Zido, are you there? Steven, are you there? Sam, are you there? Martin, are you there? Mother, are you there? Doris, Anna, are you there? Lydian, do you have the question with you? Perfect. Okay. So what are we told as far as this particular question here is concerned? So this is a very good question on conversion of partnership business into a limited liability company. And the question is, that is specifically part B. So we are told John, Kelvin, and Renette have been into partnership for several years, sharing profit and losses in the ratio of 5:3:2 respectively, after allowing for a 10% interest on fixed capital balances of the partners. No salaries or commissions were to be paid to the partners. The trial balance is at 30th of June 2024, extracted from the financial records of the business, revealed the following. So we're given the trial balance there. One, we have the profit for the year. We have the inventory as at 30th of June, of 2024. Account receivables, account payable, bank overdraft, property at carrying amount. Remember, I've said carrying amount is the same with the net book value. That is what you need to remember. We have the motor vehicle at carrying amount, office equipment at carrying amount, equity investment at fair value. We have the partners capital account, partners current account drawings, and then we have the loan from Kelvin. We have additional information. Number one, you're told actually in the first paragraph there, we are told the partnership was converted into a limited liability company, JKL Limited, with effect from 1st July 2024 under the following terms. Number one, you're told the purchase consideration of the business purchase was agreed at 150 million, and the new company issued 15 million ordinary shares of shares 10 per value in full satisfaction of the purchase consideration. So the new company was to pay a purchase consideration of 150 million. This was to be paid by the new company issuing its own shares, issuing 15 million ordinary shares, each share having a par value of 10. Number two, we are told equity investment were taken over by the partners at the fair value of 18 million and allocated to the partners in their profit and loss sharing ratio. Equity investment is basically investment in shares. This one was not taken over by the new company, but rather this one was taken over by partners. So therefore, this is an asset which was taken over by partners. And then from there, we are told number three, the loan from partner Kelvin was transferred to the new company at the carrying amount. Number four, other assets and liabilities of the partnership were taken over by the new company at the following values. At the following what values? So we are given the assets which were taken over, the assets and liabilities which were taken over by the new company. We have property, we have plant and machinery, motor vehicle, office equipment, and we are given the value at which we were taken over it. Then we have inventory which was taken over at the book value less 15%. Account receivable was taken over at book value less 10%. Current liabilities were taken over at the book value. Finally, number five, we are told the new company issued 2 million ordinary shares of shares 10 at each at par value. The proceeds from the issue were utilized to settle the bank overdraft and the loan which was taken over with the balance used as working capital. So what are we required to do here? We are required to prepare the foreign ledger account to close off the books of account of the partnership. Number one, the realization account. Number two, the partner's capital account. And number three, the partner's capital account. So actually, those are the accounts which are prepared to close off the books of account of the partnership. Then Roman 4, we are required to prepare the opening statement of financial position of the new company called JKL Limited on 1st of July 2024. So what we are going to do first of all is to cross off the books of account of the partnership by preparing the first three accounts: realization, partners capital account, and then the partners capital account. But before we do that, if you go back to the trial balance which you're given, can we go back to the trial balance? The first item in that trial balance which you're given is the profit for the year. Now, let me ask here, what happens to the profit of the partnership? If, for example, we are partners in a partnership business and our business has reported a profit, what happens to that profit which is reported by a partnership business? Who can tell us? What happens to the profit which is reported by partnership business? Where does that profit go? Where does that profit go? Is it retained as a reserve? Is it supposed to be shared? Yes, automatically, once a partnership business reports a profit, that profit is supposed to be shared among partners. We know from the definition of a partnership business is an association of partners who carries on a business with an objective of making and sharing profit. So any profit which is reported by the partnership business is supposed to be shared among who? Partners. How do we share that profit? We share that profit from what you did in the topic of partnership in financial accounting. We share out that profit by preparing something called the appropriation account. And therefore, even before we cross off the books of account of the partnership, so the first thing we need to do is to share out that profit among the partners. We are going to share out that profit by preparing something called the partners, the appropriation words, the appropriation account. So let's first of all, we prepare that account, which is called the appropriation account. So why are we preparing this account? Is to share out that profit. Appropriation what? Appropriation account. Appropriation account. And I hope you can be able to recall the format for this account, the format for appropriation account. Okay, so the figures which are given here, they are in million of shillings. So basically here, we should have two columns like that. So in preparing this particular account here, we always start with the profit for the year. Profit for the year. I hope you can be able to see that far ahead. We always start with the profit for the year. And then to this profit, we usually add the interest on drawings. We usually add the interest on drawings. The interest on what? The interest on drawings. After adding the interest on drawings which is charged to the partners, we then proceed and we raise the appropriations. When we talk about the appropriations, this is what the partners are entitled to from the partnership business, e.g. the salary and commissions, e.g. the things like what? The interest on capital and the share of profit. The share of what? The share of profit. So let's prepare this. So we're going to start by recording the profit for the year, which we are given in the trial balance, the first item. The first item in the trial balance is the net profit for the year, which is basically 42,800. Then we need to check when the partners charged any interest. When we talk about the interest on drawings, this whereby drawings is basically money or goods you take from the partnership business. The partners may have agreed that if you have taken some cash, you have taken some goods from the partnership business for your personal use, you'll be charged an interest because it is like you are borrowing from the partnership. So once you are charged an interest, that money should be added to the amount to be shared. Yes. So we must be given that in the first paragraph of the question. We are told John, Kelvin, Rinette have been in partnership business for several years, sharing profit and losses in the ratio of 5:3:2. After allowing interest on fixed capital at the rate of 10%, no salaries or commissions which were paid to the partners. And then if you go to the additional information number 1 all the way to note number 5, there is nowhere we are told the partners were charged interest on drawings. Because if you go to the trial balance, down there, above the one from Kelvin, we have drawings. So, but there is nowhere we are told the partners were charged interest on what? Drawings. But if there was any, we should add it here so that we get the amount to be shared among partners. So this is what the partners will share. So how do the partners share out this? So this one will, or basically what we do, we list now the appropriations. Appropriations basically refers to any amount of money which the partners are entitled to from the partnership business, like maybe the salaries, all what? All commissions. And there is something which you're told in paragraph 1 that the partners were not entitled to salary, they were not entitled to commission. So what they were entitled to, as per the first paragraph, is the interest on capital. Interest on what? On capital. So what we need to do here is to compute the interest on capital which each partner was entitled to. As per the first paragraph, we are told the partners were entitled to interest on capital at the rate of 10%, and this one should be computed based on the fixed capital balance. This one should be computed based on the capital contributed by each partner. So if you go back to the trial balance, we're given the capital account balance of each partner. The capital account balance of John, Kelvin, and Renette. So what we need to do is to compute the interest on capital which the three partners were entitled to. That is John, Kelvin, and who? And Renette. So, and we are told that this one would be 10%. This one would be 10% of their capital account balance. So their capital account balances, this is something we are given in the trial balance. I hope you can see those capital account balances. So the capital account balance for the first partner, who is John, is 43,700, which 10% will give us 43,70. Then Kelvin is 28,500. 10% of that will be 28,50. Then Renette is 18,800. 18,800. 10% of that will be 18 what? 1880. 18 what? 1880. So remember, this is what the partners will be entitled to, will be paid, and this one has to be paid. This one has to be paid from this. This one has to be paid from what we have up there. 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 You're saying my video is not clear. I can see from my side is clear. I can see from my side is clear. Is the video not clear? Maybe someone to confirm. Is the video not clear? I can see from my side it's clear. Yes, from my side is very much clear. From my side is very, very much clear. Very, very much clear. Very, very much clear. Very, very much clear. Sasa? Anna, is the video now clear? Ama bado? Maybe the internet on your side, Anna, maybe the internet on your side. I'm already in class and I can see my video is very much clear. Very, very much clear. So maybe you can exit, then rejoin very fast. Exit, then rejoin very fast so that we continue. Yes. So basically, that is it. Yes. So in our case, we have already computed the interest on capital. This is what the partners, one of the appropriation or one of the items the partners will be entitled to from the partnership business. So then from there, the other appropriations the partners may be entitled to, is what? Is the share of profit or the share of loss. So how do we determine the amount to be shared as profit or the amount to be shared as loss? So basically what we do is that we take this amount to be shared minus what we have there. Remember, you don't have salary or commission. We will rest those interest on capital. If we get a positive figure, that is a profit to be shared. If we get a negative figure, is a loss, is a profit to be shared. If it's a profit, if it is a positive, is a profit to be shared. If it is a negative, is a loss to be shared. Automatically, this one will be a positive. Because if you take 42 minus this, you're going to have a positive figure. So being a positive figure, that is a loss to be, that is a profit to be shared. So here we will have share of what? Share of profit. So can we determine the amount to be shared as profit? So we take that minus this interest on capital. So we have 42,800 minus 4370 minus 2850 minus 1880. So the amount to be shared as profit, I'm getting 33,700. Now that profit would be shared among our three partners, John, Kelvin, and who? And Renette. So they will share a profit of 33,700, 33,700. And how will this profit be shared? This profit will be shared using the profit and loss sharing ratio, which we have in the first paragraph. The profit and loss sharing ratio in the first paragraph of our question is 5:3:2. 5:3:2. That is for John, Kelvin, and what? And Renette. That's basically how they will be sharing the profit or the losses, the profit or the losses. Or the losses, Yes, the profit or the losses. Someone is asking a question here. Drawings about drawings here. No, I've said this. What are drawings? Number one, I've said drawings is when you go to the business, to the partnership business, you take some cash, you take some goods for your personal use. So whatever we add here is not drawings. We add the interest because we are saying if you go to the partnership business and you take money, you take goods for your personal use, in most of the cases, the partners will have agreed that you'll be charged an interest. Once you are charged an interest to the partnership business, it is like an income. It will increase the amount to be shared among who? Partners. Whatever we add there is not the drawings. We add the interest. We add what? The interest. Like is like an income. That's why we are adding it here to increase the amount to be shared among who? Partners. Also? Yes. So let's determine the amount to be shared by each of the partners. So the first thing we need to do here is to get the total. So this is the 810. So the amount which John will share will be 5 all over the total, 5 all over 10, Kelvin 3 all over 10, and Renette 2 all over 10. 2 all over 10. So that is basically how we compute the amount to be shared. That's how we compute the amount to be what? The amount to be shared. The amount to be what? To be shared. So we have that 700 times 5 divided by 10. So which will give us 16,850. Kelvin, we take 33,700 times 3 divided by 10. And basically that will give us 10,110. And then the other partner Renette, that is 3,700 times 2 divided by 10. And basically that will give us what? 6740. 6740, yes. So then we know that this amount now has been shared among partners. So therefore, if you take this amount and then you less all this, you should get 0 because that amount of profit has been shared among who? Has been shared among partners. Now, once you're through with that, then we can proceed and basically cross off the book of account of who? of the partnership. I want us to move and cross off the books of account of the partnership by preparing the 3 accounts which we are required to prepare in our question. So the first account we are required to prepare is the account which is called the realization account. The realization account. Realization account. So what we just need to remember here is what do we record in this particular account, the realization account. What do we record in this account? And our figures will be 1,000 of shillings. Will be 1,000 of shillings. This is basically the debit side. So the realization account, we have a number of items to be recorded here. Then from there, in Roman 2, we are required to prepare the partners what? The partners current account and the partners capital account. Partners current account. Partners current account. Remember, this account is also, this one is a ledger account. Is a ledger account. Partners current account is basically a ledger account. Ledger account means that this account will be having a debit and the credit side. The debit and the credit side. But here, taking into account, we have 3 partners. On the debit side of this account, we have the details column and columns equal to the number of partners. How many partners do we have? We have 3 partners. So we will have the details column here. And then column for the 3 partners. We have the first partner who is John. We have Kelvin. And we have Renette. And also our figures here will be 1,000 of shillings. Will be 1,000 of shillings. So we do the same on the credit side. Details column, John, Kelvin, and Renette. And also our figures here will be in 1,000 of what? Of shillings. And then Roman 3, we're required to prepare the partners capital account. So the reason why I'm having all these accounts, because I want us to prepare all these accounts concurrently. As we go through that trial balance, whatever is affecting this account, it will be posted to the respective account. Yes, so the partners capital account do have the same format with the partners current account. This account has the same format with the partners current account. So we have the details column and basically columns equal to the number of partners. So we have John, we have Kelvin, and then we have Renette. We have Renette like that. So then on the credit side, we have the details column. We have John. We have Kelvin. We have Renette. This, remember, is the credit side. And also the figures are in what? In 1,000 of shillings, like that. In 1,000 of shillings. So I think now we can move and basically prepare these accounts. Let's move and basically prepare those accounts. Let's move and prepare those accounts. Let's move. Now, how do we prepare these accounts? Now, what we need to recall is, for example, what do we record in this account? Remember from our discussion, I've said when preparing this account, we record like 3 key items. In preparing the realization account, I've said on this side, we record the assets, which are taken over at the carrying amount of the net book value. On this side, we have the liabilities, which are taken over, and the purchase what? Consideration. That is the first thing you need to remember, what we record in this account. Asset taken over, The liability is taken over in the purchase what? Consideration. Then, if it is now the partner's current account, you need to recall whatever you are recording here in financial accounting. In financial accounting, when you're preparing this account, you are recording the partners, the opening balance in this account, in this account, and then on this side, you are recording, I think, 3 items: the drawings, interest on drawings, and share of loss. On this side, you are recording the share of profit, the salary to partners, the commission to partners, and the share of profit. And then this account generally we record the opening balance, the partners or the opening balance in capital account, and any loss or gain on realization, which you have said must be shared among partners using the profit and loss sharing ratio. But basically what we need to do when closing of the books of account of partnership, what you do for you to get it right, go back to the trial balance which you're given here, and you need to cross all those accounts. You cross off all those particular accounts without skipping any. So the first item is the net profit. Now, this net profit, we know that this one has been shared among partners. And therefore, these particular items here, that is any interest on drawings, any salary or commission, any interest on capital, and the share of profit, all these, they'll be posted to this account. But even before you post these items here, we definitely need to record the opening balance here. So we are going only to post this one here after recording the opening balances. But all these items will be posted in this account. So then below that, what do we have? We have inventory. And actually what you're given here are items of assets and liabilities of the partnership. Now, what we need to do is basically to make reference to note number 2, to note number 3, to note number 4. The additional information note number 2, 3, and 4. Can we quickly go to note number 2? Note number 2, we are told equity investment, which you have said is investment in shares by the partners. This one was taken over by partners. This is an asset which was taken over by partners. Remember, you have said any asset taken over by partners should be debited in this account, should be debited in the partner's capital account, and then credited in the specific asset account. So one of the assets taken over by partners is the equity investment. Number 2, we are told the loan from partner Kelvin. That is the last item in the trial balance, was transferred to the new company. Is the liability of the partnership, it was transferred to the new company. Number 4, we are told other assets and liabilities of the partnership were taken over by the company. So we are given the assets and liabilities which were taken over by the company. Property, plant and machinery, motor vehicle, office equipment, inventory, account receivable, account and the current liabilities, all those were taken over by the partnership. So having that information now, we can go back to the trial balance, the second item. So the second item we have there is inventory. Inventory, as per note number 4, is one of the assets which was taken over by the new company. So that being an asset which was taken over by the new company, we debit it in the realization account at the carrying amount. The carrying amount is the value we have in the trial balance. So we will have inventory here. This is basically one of the assets which was taken over, and its carrying amount is the value we have in the trial balance. Note the value which you're given in note number 4. So the carrying amount for this is basically 28,400. 28,400. Below that, we have account receivables. As per note number 4, still account receivables was still taken over by the new company. So this is the other asset which was taken over by the new company. What is the carrying amount? The carrying amount is still the amount we have in the trial balance, which is 23,800. And I hope you can see I'm not even considering the values we have in note number 4, because we are going to use those values when opening the books of account of the new company. But when crossing off the books of account of the partnership, I've said we account for those particular assets at their carrying amount or the net book value. Sasa? Yes. So below account receivables, we have account payable. Account payable is a liability. Now, what still we are told in note number 4, we are told all current liabilities were still taken over by the new company. So the liabilities which are taken over by the new company, in our realization account, they should be credited. So that being a liability taken over by the new company, we credit it here. So their value for that is, the carrying amount for that is 32,700. Below that, we have bank overdraft. Still, that is a current liability. As per note number 4, it was still taken over by the new company. So we credit it here. The bank what? The bank overdraft. The bank overdraft, which is how much? Which is 68. So then we go to the other item, which is down here, and that is the property at carrying amount. Property, as per note number 4, still it was taken over by the new company. So that is an asset which was taken over by the new company. What is the carrying amount in the trial balance? 72,950. I hope you can see still I'm not using the values we have in note 4. Those are the fair values. We are going to use them when opening the books of account of the new company. Below property, we have plant and machinery. Still, as per note number 4, plant and machinery was taken over by the new company. So we debit that here at the carrying amount, which is in the trial balance. That is 730. So below that, we have motor vehicle. Still, as per note number 4, motor vehicle was still taken over by the new company. The carrying amount of motor vehicle is 10,580. So below motor vehicle, we have equipment. Still, as per note number 4, equipment were taken over by the new company. The carrying amount for this is 25,240. So, and then from there, we have equity investment. Equity investment, this one, was taken over by the partners. So being an asset taken over by partners, are we supposed to debit that here? No. We have said those assets which are taken over by partners, they'll be debited in this account, the partners capital account. So here we have equity investment, but basically we need to go back to the information which we have in note number 2. Can we go to the information we have in note number 2? We are told the equity investment, note number 2, equity investment were taken over by partners at their fair value of 18 million and allocated among partners using their profit and loss sharing ratio. Now, if you go back to the trial balance, you can see we are given the equity investment, and basically we are given the equity investment in the trial balance at the fair value. The fair value given in the trial balance is 10,000, but you're told in note number 2, this equity investment were taken over by the partners at their current fair value of 18 million, and this one was shared among partners, was distributed among partners using their profit and loss sharing ratio. So basically what that means is that this particular investment were taken, when it was being taken over by the partners, it had a value of this. So therefore we are going to share, or the partners will share this asset at this value, not at 10, but at 18. And therefore, how do we account for this? Which double entry are we going to make in relation to this equity investment? Remember, this equity investment, this one is recorded in this account at this particular amount. So, and basically remember, this is an asset. This is what? An asset. So therefore, these are debit balance on this account. So what we need to do is we cross off that account because those investments were taken over by partners. So we need, first of all, to cross off this account. So automatically we will cross off that account with 10,000. So therefore here you can see we are crediting this account, which is called equity investment, with 10,000, Then we will debit this account. We will debit the partner's capital account, but this account will be debited at 18 million. At 18 what? Million. So how do we account for the difference? The difference, which is 8,000. You can see this account has been debited with 18. So this account credited with 10. So we have now to credit another account with the difference. And actually this difference, we can refer to it as a revaluation gain, because when this equity investment were taken over, they were revalued from 10 million to 18. So this is a revaluation gain. Now this revaluation gain, where do we take it? So this revaluation gain will be taken to the realization account. Will be taken to the realization what account? Because by the end of the day, we have to complete a double entry. We debit this account with 18 million. We credit equity investment with 10, and still we credit the realization account with 8. So therefore, that 8 will be credited here. It is a revaluation gain on equity what? Equity investment. which is 8. Then we need to debit this account with the 18 million. But remember, those investments were taken over by the 3 partners. That's why we are told in note 2, they will be distributed to partners using their profit and all sharing ratio. The profit and all sharing ratio we know is this: 5 all over 10, 3 all over 10, and 2 all over 10. So we are going to take the value of the investment. The investment was taken over at a value of 18 million or 18,000 for that case. So we share out that using this. So the first partner will get 5 all over 10, which is basically half, and that is 9,000. The other partner will get a share of 3 all over 10, which is basically 54. And the other partner will get a share of 2 all over 10, which is basically what? Which is 36. Which is what? 36. If you add all that, it should give us an amount of 18. That's basically how we account for that equity investment, which was taken over by partners. Let's go back to the trial balance. And I hope you can see there is nothing we have skipped there. We have accounted for all those items. What we skipped is the first item. That is the profit. Then below equity investment, what do we have? We have the partner's capital account. Now, the partner's capital account, that would be the opening balance in this account. And I hope you can see those balances in the partner's capital account in the trial balance. They are on the credit side. So what do? We record those balances here and we record them as credit balances. So the capital account balance for Kevin has a balance for John, that is 43,700, Kevin 28,500, and Renette 18 what? 18,800, 18,800, 18,800, 18,800, 18,800, 18,800. Sasa 18,800. Yes. So then from there, below that we have current account balances. Current account balances, those are balances to be recorded in this account. So, and equally, I hope you can see the current account balances, they are credit balances. In the trial balance, they appear on the credit side. For John is 14,790. For Kevin is 12,960. 960, and basically for the net is what? 9850. 98 what? 9850. 98 what? 50. 9850. So then below that we have drawings. We have drawings. Where do we record drawings? Drawings, those ones are supposed to be credited, to be debited in this account. Remember, I've said from whatever you did in financial accounting, you should be able to recall what we record in this account. On this side, we record drawings. In case we had any interest on drawings, that one should also be debited here, but I hope you can remember you don't have any interest on drawings. In case we have share of loss, that one equally should be debited here. And then in this account on the credit side, we record what? We record any salary or commission to partners. Do we have any salary or commission to partners? None. Then we should also credit this account with interest on capital. And I think we have that. And then also what? The share of a profit. The share of what? The share of profit, like that. Sasa? Yes, Doris, what you have said is that the investment which were shared by partners, they are shared at a value of 18 million. At a value of 18 million. That's what you are told in note number 4. We have shared out this investment at a value of 18 million. That's what you have said. That's why you have said we debit the partner's capital account at 18 million. So if you add all that, should give us 18 million. That's that? Yes. Now, what I want us to do before we move, we go back to the trial balance, I want us to record these items. Because we have recorded drawings, before you finalize, okay, I think let's first of all finalize with what we have in the trial balance. Below the drawings, what do we have below that? The loan from Kelvin. And there is some information which are given in relation to that. Note number 3. Additional information number 3, we are told the loan from Kelvin was transferred to the new company at its carrying amount. So loan from Kelvin is a liability. So that loan was transferred to the new company. So that is basically a liability. That is a liability which was taken over by the new company. So the loan from Kelvin. So, and I hope you can remember liabilities taken over by the new company. They should be credited in this account. So how much is the loan from Kelvin? The last item is the trial balance. The last item is the trial balance is 91. So that is the liability which was taken over by the new what? By the new company. So I think you can see we are done with crossing all those balances, all those particular accounts which are balances at the end of the year. Now what is remaining is for us now to post these items here. So these appropriations. We have said in case we had interest on drawings, that one should be debited here. Salaries and commission to partners should be credited here. Then we have interest on capital should be credited here. So let's credit interest on capital here. So for John is 43.70. For Kelvin is 28.50. And basically for Renette is 18.80. Then we also have the share of profit, this one. So John is 16.850. Kelvin is 10.110. And Renette is 67.40. 67.40. So we are basically done with posting those items there. Now what is remaining is basically for us to balance this account. Okay, before we do that, there is something we are almost forgetting. Can we record the purchase consideration which is given in the last note? The last note, note number 5. Sorry, not note number 5, note number 1. In note number 1, you are told the purchase consideration on a business purchase was agreed at 150 million. Where do we record the purchase consideration which was agreed? The purchase consideration record in the business purchase account should be credited. The purchase consideration which was agreed. And that is 150 million. 150 million. I think basically we are done. So what is the remaining is for us to balance this particular account. Now the first account which we have to balance is this one, the partner's current account. Partner's current account. Now this basically account shows the amount of money which the partners were entitled to receive from the partnership business. So the balancing figure from this account should be crossed off, should be transferred to this account. So that by the end of the day, we know the amount of money which each partner was entitled to receive. So the first account which we balance is this account here. Is this account here. So let's start by balancing this account here. And I've said the balancing figure will be crossed off to which account? Will be crossed off to the partner's capital account. So how do we balance this account? We balance the current account for individual partners. So we will start with John. So we compare what we have on the debit and basically what we have on the credit. So I think on the debit side, we don't have any amount. What about on the credit side? In the current account of John, we have 14,790 plus 43,70 plus 16,850. That's what we have on the credit side. So we take what we have on the credit side minus what we have on the debit side. On the debit side, we have 0. So we should take 36,010 minus 0. So the balancing figure will be on this side. Do we record it here as a balance carried out? No. So that balance I've said we transfer it to this account. So that balancing figure, we transfer it to the capital account, which is 36 what? 010. 36,010. Oh, yes. Thank you, Otito. Morimo is almost forgetting to record drawings. Thank you. Yes, we have drawings. We didn't record the drawings. Sorry for that. So the drawings we have 4370, 4020, and what? And 29 what? And thank you for that. Yes. So it basically means that we need, before we get this, we need to raise the drawings here. We need to raise 4370. 4370. And the amount which we get here will be 31, 6 what? 40. Now we cross off this particular amount. We cross off this particular amount to which account? to this account. And basically, we follow the rule of double entry. You can see this account is credited, sorry, is debited, sorry. Then to complete the double entry, we need to credit this account. We credit this account. So we will say that there is an amount coming from the partner's current what? Current account. The amount from the current account of John is this one, 31 what? 640. So we do the same for the other partners. So Kelvin, we add what you have on the credit. Whatever you have on the credit side is what is more. 12,960 plus 2850 plus 10,110. That is what we have on the credit minus these ones, minus this value here, 4020. And that will give us 21,900. We debit it here, we credit it here to complete the double entry. So we do the same for Inet. So for Inet, we have 9850 plus 1880 plus 6740 minus what you have on the debit, 2910. And basically, I'm getting 15,560. 15,560. Are you getting those values? Is that what you're getting? Yes. So basically, in our case, we are done with this account. This is now what was required here. That is what was required in the partner's what? In the partner's current account. Now, then next, what we need to do is basically balance this account. Now, what you have said is that this account will be having a balancing figure, and the balancing figure in this account can either be on this side. If it is on that side, it is a gain on realization, and that has to be shared among partners using their profit and loss sharing ratio. If the balancing figure is on this side, is a loss on realization. Equally, it will be shared among partners and taken to the partner's capital account. If the balancing figure is on this side, it is a gain on realization. Yes, can we balance this account to see whether we have a gain or what? We have a gain or basically what? A loss. So let's add what you have on the credit, that is 2,700 plus 68 plus 8,000 plus 9,100 plus 150,000. So basically, I'm getting 206,600. That is what I'm getting on the credit. What about on the debit? And you confirm whether you're getting the sum, that value on the credit. On the debit, you have 28,400 plus 23,800 plus 72,950 plus 37,730 plus 10,580 plus 25,240. So on the debit side, I'm getting 198,700 on the debit, and that is what I have on the credit. Are you getting those values? Are you getting those values? Yes, so that is confirmed. So meaning that the side which is more is on that is this side, the credit side. So meaning, taking into account this side is more, the balancing figure will be on the debit side. On the debit what? Side. And actually the balancing figure should be the difference between those two values. 198,700 minus 206,600. So the balancing figure will be 79. 79, that is a gain on realization. So that gain on realization, we said it will be shared among partners using their profit and loss sharing ratio. That will be shared between John, Kelvin, and Renette. And who? And Renette. We are going to share out that using their profit and loss sharing ratio, which is this one. So the share of John will be 5/10, which will be 39.50. What about the other partner? The other partner, that is Renette, Kelvin, will get a share of 3/10, which is 23.70. And the other partner will get 790 times 2. And basically that is 15 what? 1580. Is that what you're getting? A gain on realization. Gain on realization, 3950, 2370, and 1580. 1580. Confirm whether that is what you're getting. Is that what you're getting? 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 Steven, Zido, is that what you're getting? Or Tito? Sam, is that what you're getting? Doris, Anna, are you getting that value? Are you getting that? Yes. So basically, after doing that, finally, what we need to do is we balance this account. We balance this account, we balance the partner's capital account, and basically the balancing figure in this account, which always is on this side, which always is on the debit side, it represents the amount of money to be paid to each partner. So the balancing figure on this side represents the amount of money to be paid to each partner. Remember, we say that the partners here have accepted to sell their business to the company. They must be paid something called purchase consideration. So what we balance this account. The balancing figure which we get here is the amount to be paid to each partner. And once we add the total amount to be paid to our three partners, the amount to be paid to John, Kelvin, and Lynette, that one always has to be equal to this. Has to be equal to the purchase what? Consideration. Can we do that? So automatically we take what we have on the credit minus what we have on the debit. We start with John. We take 43,700 plus 31,640 plus 39,50 minus what we have here, 9,000. That will give us 70,290. So that is the purchase consideration which John will receive. Out of this 150, John will be paid 70,290. What about Kelvin? We add what we have on the credit, 28,500 plus 21,900 plus 23,70 minus what we have here, 54. That will give us 47,370. So out of this 150, that is basically the amount Kevin will get. What about the net? 18,800 plus 15,560 plus 1850. That is 1580 minus 36. And basically I'm getting 32,340. 32,340. Is that what you're getting? The amount to be paid to each of the partner. The amount to be paid to each of the partner. And basically we are saying if we add this, and that should give us the amount of 150. So can we confirm? Because that is basically how we should confirm. So we take 70,290 plus 47,370 plus 32,340. Yes, you can see that basically give us that. That give us what? That basically that's how you confirm you are correct. And equally that basically what was required in that particular what? In that particular account. So what we have done basically, we have crossed off the books of account of who? Of the partnership. Of what? The partnership. Sasa? Yes. So that's basically how we cross off the books of account of the partnership. Now, there are still other questions. Like I think there was a question in 2021, which is basically similar to this one, whereby the examiner will just require you to prepare the realization account and the partner's capital account. You will not be required to prepare this account. Are we together? If you happen to come across such a question, you are not required to prepare this account. Now, all these items you are recording here, you record them in this account. Are we together? If you're not required to prepare this account, you're just required to prepare realization. And this account, all these items, you record them here. So for example, these balances, in the opening balances here, you'll come here after recording this one, you'll come and record this opening. You'll not refer to it as a balance carried down because you already have a balance carried down here. You'll say that this is the balance from the current what? From the partner's current account. You record these balances here, all of them, and then all these items, you credit them here. All these items, you do what? You debit them here. So in case the examiner has not required you to prepare this, all these items, you record them here. I think there is a video I'll be able to share with you of a question, I think in 2019 or 2021, which is basically similar to this, but the examiner was not requiring candidates to prepare this account. This one, the candidates were required to prepare this and this. So all these items, you record them here. Sasa? Yes. Now, having that, I want us to finish by preparing the statement of financial position of the new company. That's what we required in Roman 4. But before we prepare that account. Is that the case? Yes. So let's basically finalize by preparing the statement of financial position. Preparing the statement of financial position, but there is an account we need to prepare. Remember what we have said. When opening the books of account of the partnership of the new company, we have to prepare an account called the business purchase account to determine whether we have goodwill or basically capital reserve. But let's first of all, we prepare the statement of financial position. We will be able to, I will show you how to prepare that. So we prepare what is required in Roman 4, opening statement of financial position of the new company, JKL Limited, as at which date? We're given that date. We are given that date. My Modimus question is disappearing here. The date is as at first of what? As at first of my question is disappearing. Yes, it's at 1st of July 2024. This is basically immediately after the new company took over the business of who? Took over the business of the partnership. Took over the business of who? Of the partnership. Yes. So here, what you're going to record, the assets the assets and the liabilities which were taken over by the company from the partnership. And when recording the assets here, we record them at the fair value. The assets were taken over at the fair values given in note number 4. So what we do, we record those assets here at their fair value. So we have the non-current assets. So let's record the asset from note number 4. Actually, here we have so many free marks because you just need to pick those assets we have in note number 4. So the first asset which was taken over is basically property, and we record that asset here at the fair value, not the carrying amount we have in the trial balance, the fair value. So this one is 74,560. So then below that we have plant and machinery. Plant and machinery was taken over at 35,200. Then we have motor vehicle. Motor vehicles which were taken over at a value of 95,20. Then we have office equipment. You can see all these are free marks. which was taken over at 23, 6 what? 23,660. 23,660. Then inventory account receivables, those are items of current asset. But what we need to do here, we are going to leave some space because there is an account we need to prepare that is called the business purchase account. We determine whether we have a goodwill or the asset and abilities of partnership was taken over by the new company as a goodwill or capital reserve. So leave some space here. In case we have a goodwill, we are going to record it there. And then from there, we proceed and basically record the current what? The current assets. Now, the current asset, we start by recording inventory, which is given in note number 4. We are told the inventory was taken over at the book value less 15%. In other terms, we can say the inventory was taken over at a value equal to 85% of the book value. Can we say so? Can we say that the inventory was taken over at a value equal to 85% of the book value? Yes. What is the book value? The book value is what we have in the trial balance. And basically, those inventory are the second item in the trial balance. The book value is 28,400. 28,400. But in this case, there is also some information which we have in note number 5. Let's go to note number 5. We are told the new company issued 2 million ordinary shares of sharing 10 each at par value. So this new company issued shares, 2 million shares, sharing 10 each. And then you're told the proceeds. The proceeds is the amount which was received from the issue of shares was utilized to settle the bank overdraft and the loan which was taken over, with the balance being used as working capital. There are some instances whereby you may be told that maybe part of that money which was raised was used in terms of buying additional inventory. So in case maybe there was additional inventory which was bought, we should add that here, but none. So let's get 85% of 28,400, and basically that will be 24, 140. So then we go back to note number 4. Below inventory, the other asset which was taken over is the account receivable. Account receivable, which was taken over at book value less than 10%. In other terms, we can say that this one was taken at a fair value of 90% of the book value. 90% of the book value. The book value is, we have it in the trial balance, the third item in the trial balance up there, which is 23,800. 23,800. So we get 90% of that times 23,800. And basically that will give us 21 for what? 420 years. So then in note number 4, I think the other information we're given here is about the liabilities. But it is also important for you to note that this partnership business had an overdraft. And then what you're told in note number 5 is that this company issued some shares, it raised some cash. That overdraft from the partnership was settled. Automatically, there is some amount of money which remained in the bank. So what we need to do here, we need to prepare a bank account, and we determine how much bank balance, how much amount of money was left or remained in the bank account from the amount which was raised from the issue of shares, and after the payment of the two liabilities, after the payment of the overdraft and the loan, how much amount was left, how much amount remained in the bank. So we can only be able to do that by preparing a bank account. We can only be able to do that by preparing the bank account. What do we record in this account? In the bank account, you're going to record the amount of money which was raised through the issue of shares as per the information we have in note number 5. We are told the new company issued 2 million ordinary shares of sharing 10 each at par value. So once the company issues shares and the company receives some cash, that cash should be debited in the bank account and then credited in the share capital. In our case, we're interested in money received. 2 million times 10. The amount received is 20,000. Remember, all our figures are in thousands of shillings. Then in note number 5, we are told this amount of money, which is 20 million, that is paragraph sentence 2 of note number 5. The proceeds from the issue were utilized to settle the bank overdraft and the loan which was taken over from the partnership, with the balance being used as the working capital. So there are two items which were paid. Those two items which were paid should be credited here. The first one which was paid is the loan, and the other one is the bank overdraft. And basically, the loan which was taken over from the partnership is the last item in the trial balance. In the trial balance which we have there, the loan which was taken over from the partnership had a value of 91. I hope you can see that in the trial balance, the last item. And then the bank loan, the bank overdraft, sorry, is up there where we have net profit, inventory in the trial balance still, account receivable, account payable, we have bank overdraft of 68. So those are the two items which were paid. So automatically the balance that we are going to account for it here as a current asset. So let's just get the balancing figure. So we just take 20,000 minus the two items which were paid, 91 and 68. So that will give us what? That will give us 41. So this is the amount of money which was left in the bank account. In the bank account, that one would appear here as a current asset. As a current what? As a current asset. Anything which is remaining here? No. But automatically we can't get the total because we need to compute to determine whether we have goodwill. And then that is the only time we will come back and we get what? The total assets. So before we do that, then we move. So remember there is something we need to compute there. I'll show you how we compute that. We proceed and record equity. Remember this is now a company. Now this company here will be having a share capital. So the share capital of this company will be equal to what? Number one, we have these shares which were issued for cash as per note number 5. The shares issued for cash had a value of 20,000. Number 2, if you go to the information you have in note number 1, we are told the purchase consideration on business purchase was agreed at 150 million, and the new company issued 15 million ordinary shares of shillings 10 par value each in full satisfaction of the purchase consideration. Now, this company, we are told, also issued 15 million shares, each at a par value of 10, and these shares were issued to the partners to pay the purchase consideration. Remember, the 3 partners were to be paid 150 million. They were paid this by being issued with the shares of the new company. So this company issued some shares in cash, and then there were these shares which were issued to the partners to pay the purchase consideration. So 150 million plus 20, and that will give us a share capital of 170 million. So that is the share capital of this company. Then, after preparing the business purchase account, we need to determine whether we have a capital reserve. I've said after preparing the business purchase account, we can have either goodwill or capital reserve. We will see. And then we will get what? The total equity. The total equity. Then from there, we need to move and record the non-current what? Liabilities. The non-current liabilities, in this case, do we have any non-current liability? Any non-current liability? Is our company having any non-current liability? Automatically, no, because this company took over a bank loan from the partnership, and I hope you can be able to recall the bank loan has been repaid. So that bank loan will not appear here. Finally, we record the current liabilities. The current liabilities. So there were some liabilities which were taken over from the partnership. And where do you get those liabilities which were taken over from the partnership? If you go to the realization account, can you go back to the realization account on the credit side? In the realization account on the credit side, you can be able to see the liabilities which were taken over. I think there are 3. The account payable, there is the bank overdraft, and there is the loan from Kelvin. Are those the 3 liabilities which were taken over from partnership, from the realization account on the credit side? Are those the 3 liabilities? Yes. Now, what we know is that 2 liabilities have been paid. 2 liabilities have been paid. The bank overdraft has been paid, and the loan from Kelvin has been paid. So the only liability which has not been paid is the trade or account payable. Or account what? Payable. So what we are going to record here as the only current liability of the company is the account payable. The account payable in the trial balance is 32,700, 32,700, 32,700. Yes, and I think basically we are done. So what is remaining is we do just one working, which is remaining, and which should not take us even 2 minutes. So what we need to do here is we prepare, there is an account always you must prepare called the business purchase account. Why do you have to prepare this account? Is for you to determine whether you have a goodwill or a capital reserve. A goodwill or a capital what? Reserve. And I hope you can remember I gave you the format for this. We said we record 3 items here. 3 items. Assets taken over at the fair value, liabilities taken over, and the purchase consideration. 3 items. What do we debit on this side? What do we record on the debit side? We record the liabilities taken over. And actually what we will do, we will get the total. We also record the purchase consideration. Purchase consideration, we know this one is 150, no problem with that. And then on this side, we record assets, which are taken over at the fair value. I think first of all, we can get this because from the balance sheet which we have, we know the assets which were taken over. The assets which were taken over here include this, that, inventory, and receivable. Remember bank balance. This is not an asset which was taken over. We are going to exclude this. So what we need to do, can we add all these assets excluding bank balance? Excluding bank what? Balance. That was not taken over. So let's add the other assets. We have 74,500 plus 35,200 plus 95,20 plus 23,660 plus 24,140 plus 21,420. I'm getting the total value of the asset which was taken over as 188,440. Confirm whether you're getting that. Are you getting that value? 188,440 as the total fair value of the asset which were taken over? Yes. So then on this side, we have the liabilities which were taken over. The liabilities which were taken over, where do we get that? Although in our case, we know the liabilities were taken over from the realization account on the credit side. And we know that the liabilities are taken over at their book value. That's basically what we know. Can we add those 3 liabilities? The 3 liabilities is this bank loan, the overdraft, and the payables. We can add those 3 values. So the bank loan is 91 plus 68 plus this. That is 37,200. So that will give us 48,600. $48,600. And then we balance this account. A balancing figure on this side is goodwill. A balancing figure on this side is capital reserve. Capital what? Reserve. What do we have in our case? I think whatever you have on the debit side should be more. 48,600 plus 150,000. That will give us 198,600. So the debit side is more. Automatically, the balancing figure will be on this side, which will be a goodwill. 188,440. So you're getting a goodwill equal to a goodwill of how much? A goodwill of how much? Yes, a goodwill of 10,160. That is the figure I'm getting from Anna there. Is that what you're getting? Someone to confirm that. Someone to confirm whether you're getting a value of 10,160. 10,160, is that what you're getting? So that we weighed up? Yes. So that therefore is a goodwill. So we record that goodwill here. 10,160. So it means that here we don't have a capital reserve. We don't have a capital reserve. So I think we are done now. So we just need to balance. So remember, we already have this total. We have added all these assets, this, that, excluding this, that, and that. And after adding all these assets, we had this total here. So what we will do, instead of re-adding again, we will take 188, this one, 188 for 40. Remember, you have added this, that. This one is not included, so therefore we add 10, 160. What else have we not included in that total? This one, the bank balance, 41. So that will give us what? That will give us 202,700. 202,700. Yes. Then we do the same here. So total equity will be 170,000 plus this. 170,000 plus 32,700. That will give us 202 what? 700. 202,700. And basically we are done. You can see our statement of financial position is automatically what? Is automatically balancing. Is automatically balancing. So that basically what is required as far as that last part of the question is concerned. So the marks allocated here are basically what? 5 marks. Well, 5 what? 5 marks. That what was required as far as that question is concerned, and equally, that basically how we account for the conversion of a partnership business, into a limited liability what? A company, into a limited liability company. There is another similar question, which another question similar to this one. Let me see the year in which it was examined. Yes, so we have a similar question to this one, November 2019, which is question number 1B. Question 1 what? Question 1B. So make sure you